and you're conducting your movement.
Okay. So guys, investment decision, basic summary. So conceptual approach. Guys, number of methods that can be used when making an investment decision. Decision making is done using both quantitative and qualitative. Now guys, as far as your exam's concerned, I'm pretty certain you will get something which asks you to do qualitative factors in an exam. So I think that you have got 100% chance of getting qualitative factors in an exam. So it's little stuff like they ask you, they say you want to buy a new machine. So a qualitative factor might be something along the lines of, does the machine come with a warranty? And if it gets broken, can someone fix it? Do you guys understand where I'm coming from? And if it's a quantitative decision, what's going to happen, guys? Calculate NPV, calculate IRR, calculate all of that stuff. Are you guys comfortable with that? So quantitative and qualitative. Traditionally in an exam, guys, you're not going to get these big like 30 or 40 mark things that you actually used to get in undergrad. Do you remember you used to get these big MPV calcs out of 30 or 40? Okay. What's going to happen is they're going to give you these small little calculations, maybe 10 marks, but they're going to put tricky stuff into the 10 marks itself. And sometimes they're actually going to give you some of the numbers and ask you just to fill in the remainder of the numbers within a calculation. Are you guys comfortable with that? Now, as far as number crunch is concerned, I'm going to do an example with you just now, and I'm going to show you how to do it quickly. Because in postgrad, you really, really struggle with time. So I'm going to actually show you how to do it quickly, and then I'm going to show you how they can actually manipulate the wording to cause shit in your lives. So I'm going to try to show you the tricks with the wording as well. And that's how I'm going to finish tonight. Okay, but I'm just going to go over the basics beforehand. So I've got here, decisions are made once both qualitative and non-qualitative decision making has been considered. So like for qualitative, I'm going to show you sensitivity analysis. So sensitivity analysis will be what happens if the selling price of the goods changes by 10%. Are we still happy or we're not happy? That type of scenario. So we'll do a bit of scenario planning, that type of stuff within a question. Guys comfortable with that? So that will be qualitative. Guys, quantitative decision making. Now guys, I'm going to go through payback and discounted payback periods simply because when you're 4861 students, I've actually seen them actually ask it in exams. I haven't really seen them do payback and discounted payback in a 4862 exam, but I have seen them do it in class tests for 4861. Okay, so more, this is kind of like more for the 4861 guys. So payback period, guys, I'm going to go through and just revise from undergrad. Guys, so method one, payback period, logic. Okay, so guys, I need you to understand, can you see I've got logic and I've got assumptions and I've got advantages and disadvantages with all of these things. So in an exam, guys, you need to understand a math paper is basically a little bit more than half discussion. Does everybody understand? So they're more likely in a postgrad exam to look at you and say, do the NPV calc. And then they're going to sit there and say, what are the advantages of the NPV method? What are the disadvantages of the MPV method? Or explain to a client why this is a good investment basis or not a good investment basis. Do you guys understand? So these little things where I've got logic there and stuff like that, they ask that stuff in exams. They want you to be able to explain it and understand that type of stuff. Okay. So logic with payback, it says the longer it takes to pay back the project, the higher the risk of the project. You guys comfortable with that? So quicker I get my money back, the less risk I have. Next dot. When comparing a project, take the project with the lesser payback period. 2 years payback is better than 3 years payback. So often in an exam, they won't ask you to do the calculation. They'll say, these are the results, tell us what to do. So do you understand? A project with a 2-year payback is better than a project with a 3-year. I get my money back quicker. Third, it says, the payback period provides a measure of both the project's liquidity and risk. So, quicker I get paid back, more liquid. Okay, quicker I get paid back, less risk. Guys comfortable with that? Okay. So, and it's quite common in exams for them to actually give you the answer and ask you to comment on the answer. Next one, evaluation criteria. It says payback period less than target accept, payback period greater than target reject. So guys, so what a business will do is they'll say, if it's, we will not take a project that takes longer than 3 years to pay back. Okay. Now guys, I have a problem with it because how do you work out 3 years is a good number or not? Okay, it's the feeling I get in my left testicle when I wake up at 4 o'clock in the morning. You don't know whether 3 years is good or whether 3 years is bad. NPV is quantifiable. You know whether it's good or bad. Whereas with payback, it's like a big thumbs up. Are you guys comfortable with that? Okay. So, guys, it says if one out of the two projects can be taken, choose a project with the shortest payback period. Are you guys comfortable with that? The basic principle, guys, we always use cash flows. Why do we always use cash flows? Not profits. Because a profit can be manipulated. It's like sitting there. It's like saying, you look at the accountant and he says, what would you like the profit to be? It can be this, it can be this, it can be this, it can be this. Okay? Do you guys understand the problem with profits? Cash flows are manipulated. You guys comfortable? So every single thing has to use cash flows. Okay? So it says a limited invests in all projects that have a 3-year or less payback period. Project A requires a company to buy a machine at a cost of 10, which will last the 5-year life of the project and be sold for 1,000 scrap. And it gives you cash flows for each of the years. So what do? We say 3 plus 4 is 7, plus 5 is 12. Sometime in year 2, we go past the 10,000 Rand cost. So this has got a 2.6-year payback period. Does everybody understand where I'm coming from? What is your criteria in the question? It says we've got a 3-year payback period criteria. So what are we going to do? We are going to take it. Are you guys comfortable with it? Happy with payback? Okay. Advantages. Simple. It is very, very simple. Acceptance rejection is made easy. More than 3 years, accept. Less than 3 years, accept. More than 3 years, reject. Says bias towards short-term projects and liquidity. It bias towards projects that give you more cash early on. Okay, so Sasol have got that Lake Charles project that they've been doing for more than 10 years. Okay, it would never ever have been accepted under a payback period, because this is something that's going to be generating revenue for the next 50 years for them. And do you understand, something like that project would never ever be undertaken if it was the payback period that would be the relevant one. And then it says good method to evaluate high-risk projects. Very, very high risk. Good method, because you don't know how much cash you're going to get back. Are you guys comfortable with this? So like if I was dealing with SAA at the moment, I would probably say payback's not a bad thing if you want to actually have a look at something. Because I don't think you can look more than a year or 2 years down the line with SAA at this point in time. Or the government can continue to print money, the inflation will go up, we'll hyperinflate, and the currency will be worth a ball of shit, which is what Tito Mboweni is saying. And he's being told to toe the party line. So as long as you actually invest offshore, then it's fine. Okay. So yeah. So maybe Ace is investing his money offshore, so he doesn't mind telling Tito Mboweni to shut up. No, I don't know. Okay. So I'm being very facetious. But the other thing is, you'll see that I do speak about current developments a lot, because that pops up in your exam. So things that are happening currently in the marketplace, I will speak about. And hopefully you'll get it in the exam. 2 years ago, I spoke extensively about Woolworths in class, and Woolworths was your case study at the end of the year. Okay? So if there's a big thing happening in the marketplace, they often base your year-end exam on something that's happening out in the marketplace. So I'll try and make sure that you actually know what happened. Because normally the case study will follow what happened, and you'll know where to go. Okay, let's carry on. Okay, disadvantages. Ignores time value of money. Cash flow year 1 is the same as cash flow from year 2, same as cash flow from year 3. It's always bad to ignore the time value of money. 2, ignores risk. Guys, there's no discount rate. With NPV, what do? You discount by a risk rate. This one, it ignores it. Okay, you treat a project the same as another project. So someone comes to you and says, I think I can make gold out of water. And another person comes to you and says, let's open up a KFC. Okay, you're going to treat it as the same risk, even though KFC is probably the one that you more of a sure bet. You guys comfortable? Guys, next one, ignores cash flows after a payback period. So if anything happens after the payback period, it ignores it. And then the last one, the target is subjective. What is a good payback period? You don't know. Guys, comfortable with that? Then we've got discounted payback. And all we do with this one is we discount the payback period. So we use the time value of money in here. I'm not going to do it with you. You guys can look through the notes and you can do it. Okay? The 90% more likely thing in an exam will either be NPV or IRR. Are you guys comfortable with that? So it's exactly the same discussion for discounted payback, except you use time value of money in discounted payback. Okay? So I want to go to net present value here. Okay. So here's where things happen. Okay, I don't know what theory they're going to throw your way in an exam. So I'm just trying to be preemptive. So they can look at you in an exam and they can say, what are the assumptions of NPV? Now, guys, the assumptions of NPV and IRR are identical. So I just want to say something beforehand. NPV and IRR will always give you the same answer. They use the same logic. They just one uses a percent and the other one uses a rand value. But NPV and IRR will give you identical answers. So when you learn the assumptions for NPV, they're the same assumptions that you have for IRR, barring one thing, which I will explain is the difference between the two. Okay? So investors are rational is an assumption of NPV. 2, investors seek to maximize their wealth in terms of cash. So one of the assumptions of NPV is cash flow is king. Okay? 3, it says capital markets are perfect. They are reasonably efficient. Okay? Most capital markets are quite efficient. Okay? Investors are risk averse. Why would you say that that's an assumption of NPV? Because we discount by a discount percentage. The more risky it is, the less chance you have of taking it because your discount rate is taken into account. And then it says assume surplus cash flows can be reinvested at the WACC. That's what NPV does, by the way. The only difference between NPV and IRR is with IRR, it assumes that the investment cash flows can be reinvested at the IRR rate. Okay? Which one's better, just before we start doing them? If they look at you and say, which one's better, which one's better? NPV is. Because if I get money, I can reinvest it into my company at the WACC rate, which is a reasonable assumption. If you have IRR, you can't find projects that are much in excess of your WACC rate all the time. So assuming that it goes back in at IRR is a misnomer. Does everybody understand that? So NPV is superior to IRR, but they give you the same answer. But let's carry on. Okay, so logic. Okay. Guys, it says stakeholders need to be compensated for the risks that they assume. Shareholders need to be compensated at the cost of equity and debt holders at the cost of debt. Does that make sense? So what have I taught you with WACC? I've said WACC is an average of debt and equity. So the risk of the company is combination of debt and equity. So one of the logics behind it is we get to use WACC inside our NPV decisions. 2, it says it's assumed that weighted average cost of capital can be calculated for the company, and this should be used as a discount rate to compensate stakeholders if the risk of the enterprise approximates the risk of the investment. So guys, we assume that the risk of the company is the same as the risk of the investment. 3, it says adjustments may be made to the cost of capital where risks are different. As I said, in the year-end exam 2 years ago, they said add a 7% risk premium on. So you just went WACC plus 7. Next, by discounting at this rate, the projects will be accepted or rejected based on whether they have the positive, accept, 0, accept, or negative, reject NPV. So guys, if NPV is 0, the thing is accept the project, even if it's a 0. Tell me why if it's 0, you accept the project. It's giving you your required rate of return. I'm happy to do it. But then I would say look at qualitative considerations. What are the chances of the Oaks going on strike? Have I taken it into account in my numbers? because 0 doesn't give you much leeway. Are you guys comfortable with that? But in a question, they often will sit there and say, NPV is 0, should I accept it? And the answer is yes. Quantitatively, yes. Guys comfortable with that? And then last one. All cash flows will be reinvested at appropriate discount rates. That's cool. Let's carry on. So it says here, question 3, net present value. Now guys, there are whole lots of stuff. Independent projects, mutually exclusive projects, divisible projects, non-divisible projects, profitability index, capital rationing, unequal lives of projects, all of that shit next week. Are you guys comfortable? For tonight, I just want to make sure that you know how to do a basic NPV calculation. Is that all right? So all of that shit that they make you cry with next week. Okay, and I'll take you through it step by step, and I'll show you shortcut methods with your financial calculator. So it'll be easier than third year, because when you use a financial calculator, life is much, much easier. In third year, you didn't know whether were going to ask you to draw up a table or do stuff like that. Is that all right? So it is easier than third year. So here it is. It says project A requires a cash injection of 150 today to acquire a machine. It will generate a revenue of 60,000 for the next 3 years. What is the net present value if the discount rate is 7%? Is that all right? So I just want to make sure you all know how to do your calculators properly. So, guys, with this question, how much does it cost you? 150. So most of you will have HP 10-2Bs, I would imagine. Okay. So the first thing you need to do, please just clear your cash flows on your calculator. So just make sure that your cash flows are totally cleared on your calculator. What you then will do, guys, is you'll say 150,000, and the first cash flow is a minus, yes? And you hit your plus minus button, and then push your cash flow button, and it should say CF0 minus 150,000. Then, guys, type in 60,000. If you've got an HP 10-2B, just go cash flow, cash flow, cash flow. As you do it, it'll go CF1, CF2, CF3. Guys comfortable with that? And then, guys, it knows it's 3 years. You don't need to put 3 years in. Does everybody understand? Because you put CF0, CF1, CF2, CF3 in. 7, and hit the R button. You guys comfortable? And then you need to hit the NPV button. On the HP 10-2B, you need to push second function, which is the orange button. And then you'll see NPV is below one of the numbers. It's below PRC. And if you plug that in, you get an NPV of 7459. Is that all right? Now, in an exam, that's how you do it. You actually write out CF0, CF1, CF2, CF3, CF4, whatever. I7, compute NPV, and that's how they mark it for you. Are you guys comfortable with that? Please don't do it manually unless you... Seriously, just do a calculator. You guys comfortable? Or you can spend 20 minutes doing that manually and cry, and you can use tables. No, they don't give you tables in an exam. You have to use the calculator. Tables are an approximation. Rather use the thing that gives you the right answer. Are you guys comfortable with that? You happy with how to do an NPV calc? Now, guys, it's exactly the same thing if you're doing IRR. The only difference is you don't need to say I7. Okay? You just need to say compute IRR, and it'll give you the IRR for the project. Is that all right? Guys comfortable with that? You happy with this? Is that cool? Okay. So if you go compute IRR now, you'll see that it'll give you something. Advantages. Now, guys, I very rarely say learn things off by heart, but this is something to learn off by heart. Okay? They so often in tests and exams actually ask you to list advantages and disadvantages. Please, will you learn it? Just in case. So, guys, advantages recognizes time value of money. So that's good. Should recognize time value of money. That's important. 2, considers cash flows of the entire project. So it's not like payback. Payback, after you've got your payback, you ignore it. This considers every single cash flow that it gives you. 3, discount rate can be adjusted for risk. It's 7%, but you know what? This is project's riskier than the company, so I'll add 3 onto it. 4, assume surplus cash inflows can be reinvested at WACC. That's good, because that's what it should be happening, guys. My company generates a return of 15% WACC. If I've got money in it, that's the money that I'm going to be able to generate traditionally. Guys, disadvantages. WACC concept is difficult, so it's quite hard to calculate WACC in practice. 2, WACC is complex and subjective. What's the target debt equity ratio? Okay. Adjustments to WACC can be manipulated, and the answer is a random amount and not a rate. Now, personally, I find a random amount much more comfortable, but most people prefer to actually see what your percentage return on an investment is rather than a random amount. Are you guys comfortable with this? Is that cool? Okay. Carrying on, guys. IRR. So guys, IRR, exactly the same way that you plug it into a calculator. Instead of saying compute NPV, what would you do? Compute IRR. And then what's the thing, guys? If the IRR is bigger than your WACC, then you accept. So you'll see here it says 9.7 is the answer in this question. So you'll accept the project. Do you notice that? Same answer as NPV. NPV was positive, accept the project. Are you guys comfortable? Now, I personally don't like IRR in practice. Can I show you why? There are a couple of problems with IRR, and I just want to just show you. So basically, guys, it says here advantages. The answer is a percentage and is easier to interpret. So bigger than WACC, we accept the project. Personally, I don't see the problem. It's positive, accept NPV, but yeah. Is that all right? But can I just show you something as to why you shouldn't use IRR in practice? So I'd like you to clear your calculators, and I'd like you to go minus 100, cash flow 0. So minus 100, cash flow 0. Positive 150, cash flow 1, compute IRR. What do you get? You get 50. Is that right? Okay, so now I want you to change things around. So we said minus 100 plus 150. So this time what I want you to do is I want you to say plus 100 and minus 150 and compute IRR. And what do you get? 50. So with IRR, you don't know whether you're getting a profit or a loss. So in practice, please try not to do IRR, because it will give you a percent, but it'll give you either a percentage profit or a percentage loss. And you're not going to know whether it's a profit or a loss, because your calculator doesn't do that for you. Is that all right? So I would veer away from it in practice. The other thing that happens with IRRs is sometimes they give you two answers. If you've got a more complicated calculator, you can get more than one IRR answer. And the reason for that is where you've got sign changes inside an investment. Every time there's a sign change, you get another answer. And you're not going to know which is the answer to look at. So if there's two sign changes, you're going to actually find two answers. So two sign changes is fine. Minus then a plus is fine. But if it goes minus, plus, minus, plus, minus, plus, every time the sign changes after that, you'll get an alternative solution because it works like a parabola. Okay? And you're not going to know which one is the relevant one because at different stages, depending on where you are, you'll have positives and negatives. Is that all right? So I prefer NPV in practice. It doesn't suffer from those problems. Are you guys comfortable? Okay. But yeah, this is just to actually just remind you about stuff and to do the calcs. But I'm more interested in what I'm about to do with you. This is just trying to actually just remind you about the stuff. Okay? Guys, I wouldn't look at marginal IRR and stuff like that. Why do you have modified IRR in practice? Because it takes all the terrible stuff about IRR and actually modifies it back to an NPV answer. But you don't need to know that as part of your course. Okay. So what I'd like you to do now is turn to the next thing. Now that's the solution. So guys, drawing up cash flows. Guys, let me show you what's going to happen with this. There's an example. Is that all right? And what I'm going to do is I'm going to refer back to this example all of the time as we're going through stuff. There are some errors that you will make, but I'm going to try and make sure you know how to do a number crunch properly. Is that all right? So what I'd like you to do first is, can you read through this basic teaching example? Okay, so read through it so that you know what's there. Is that okay? I'm just going to push pause. Guys, I'm just watching you use highlighters. I hate highlighters because they mean nothing. Okay, if you want to do something, rather write down the word cash flow, because you know it's an NPV calc. Okay, or do something along those lines rather than highlights. Highlight shows you nothing. So when you go through a paper, I need you to understand you got a test and they give you reading time. So you actually get given reading time in postgrad. So what will happen is your class tests are 75 minutes long. They give you 15 minutes of reading time, and you are not allowed to actually start answering your paper until 15 minutes goes by. So you might as well use it constructively. So if you looked at a question like this, you definitely you could see that there's an NPV calc here. Huh? So instead of highlighting something, rather, if you want to highlight, it's fine. Then just basically say blue highlighter, I'm going to highlight all of the cash flows. Are you guys comfortable? But you'll see when I start going through questions, I start marking off. I write down the word positive cash flow, negative cash flow, or stuff like that. If I start doing a tax question, every single thing I see there is either income or deduction or capital gain or VAT or whatever. And I make it look like a Christmas tree, because then I can find stuff very, very easily later on. And what I'm also able to do is, because I've written something, when I put it into the solution, I cross it out so that I know that I put it into the solution. So when you write down a word, when you cross out the word, you know you don't need to look at it anymore because you put it in the solution and you've dealt with it already. But I'm not going to do that tonight with you, but just think about that concept. Is that all right? Because you know what happens is, like with your Mac exam, you've got a 3-hour paper, so you read for half an hour. Okay, and then what happens after you've read for half an hour? When you get back to it in 2 hours' time, you see highlighted shit and you don't know where to find anything. So it's better if you write stuff down and you actually use words, because you can find stuff better if you use words rather than highlighting. Does that make sense to you? But I'm going to spend a lot of time doing that with you. Okay? And you'll see it's much better. You can find stuff better. You don't leave stuff out. Because at the moment, you guys have used one color highlight and you've got something that looks like this. I'm sorry. You don't know what's important, what's not important, where to find shit or not. So I'd much be happier to actually write down sales cash flow and machine cash flow and stuff like that, rather than highlighting shit, because you're not going to be able to find anything. Are you guys comfortable with that? So just think about that as a concept. When I do some examples with you, you'll see me do that. Okay. So let's start. Okay, so first things first, do you have a set layout for doing an NPV question or not? You do. So someone wants to share it with me. You said you do? So what are you going to do?
You start from year 0, you put 5 lines across every many years you got.
Mm-hmm.
So year 0 to year 5.
Mm-hmm.
Every cash flow you have, you put it in the total from top to bottom, starting with your positive cash flows,
Okay.
then your negative cash flows, and then you bring it to a bottom total, and then you discount that back to
Okay. So for tax, what happens with tax?
taxes in there.
Tax is a cash flow. Do you need to do your own separate tax calc? Okay. So I just want you to actually just think of something, and I'm going to do the solution in a certain way. But what I'd like you to do is I'd like you to actually just think about the way that I do this. So what I'm going to suggest for you to do, guys, is technically in every single cash flow, calc, there are 3 sections in every single cash flow. And I'd like you to think about those 3 sections themselves. So I'm just going to actually just show you my format, and you're going to see my format at the end, and you're going to see that it's a little bit quicker. Okay? So essentially what I do is I sit there and I say, listen, I know I've got a tax calc, and it's going to be at the bottom. Okay? And what I'm going to do is, for time 0, time 1, time 2, I'm going to work out a cash flow down at the bottom. Does everybody understand? But then I've actually got my actual cash flows up at the top here, and I just want you to understand what I'm doing. Now, inside this section, I prefer to have two separate sections inside the cash flows. So I like to have section 1, and section 1 deals with, it goes into the tax calc. Okay. And then I've got section 2, which does not go into a tax calc. And let me just explain. I watch people in exams, and like they've got 10 line items in a question. So what do? You do sales in the cash flow, and then you go and you write sales, and you do it again in the tax calc. And then you do cost of sales in the top section, and you do cost of sales in the bottom section. And then you do marketing in the top section, and you do marketing in the bottom section. Okay? To me, writing out everything twice in an exam is a waste of time. Not only do you need to add up everything twice, but you're wasting your time. So look what I've said. I've said section 1, it goes into a tax calc. So when I do the question, I'm going to separate my cash flow into two parts. And everything that goes into the cash flow, into the tax calc, I'll do together. And everything that doesn't go into the tax calc, I'll do separately on the page. But then what I'll do at the end of it is I'll add up what goes into my tax calc, and then I'll just transfer the total number down into the bottom. Does everybody understand? And I should be able to save 10 or 15 minutes time doing this question. Does that make sense to you? But bear that in mind when I set it out. So I'm going to go through it, and we're going to discuss that. I'm going to discuss which one of the 3 sections stuff goes into. So guys, sales should go into the section 1. Does everybody understand? Buying a machine will go into section 2. Why will buying a machine go into section 2? Because that's not what goes into your tax calc. What goes into your tax calc? Depreciation. Or what? Your tax depreciation, yeah. Are you guys comfortable with that? So just bear that in mind as I start going through the solution. Is that okay? You happy with that concept? Okay. So I'm going to set it out like this when I go through it. Okay. So let's go through and let's have a little bit of a discussion. Okay. It says the following is relevant when answering investment decision questions. So I want you to just think of stuff. It says in traditional NPV calcs in academic questions, the timing of cash flows are normally assumed to happen at the beginning or the end of a year. That is a weakness. So guys, in any exam, when they ask you for qualitative factors, what is one of the qualitative factors automatically? In our calc, we assumed all the cash flows are at the beginning or at the end of the year. This does not happen in practice. Therefore, our NPV is slightly wrong. Are you guys comfortable with that? So there's an automatic qualitative problem with it. Okay. Guys pay over time. It's not like everything, you only have 2 days where money goes into your bank account. Guys comfortable with that? Okay. It says, read the question carefully and determine how many periods the cash flow table needs to be drafted for. Okay, so having read this question, how many periods does this cash flow table have to be drafted for? Okay, guys, so in this question, how many periods are we going to do it for? Guys, we're going to do it for, not for, 5, because there's always initial, all the stuff that you invest for up front. Are you guys comfortable with that? So I'm going to set up a table. So essentially, I want you to just understand how I would set it up in a question. Now, guys, you get given an exam question. So what I would do automatically is you get given 2 pages next to one another. Does everybody understand that? So what I would do is imagine this was the page in your exam. I would sit there, and at the top of this page, I would go cash flows. And then I'll just put tax in. And then halfway down the page, I'd go cash flows, not tax, the heading. And then I would, at the top here, I'd go tax. Okay? And in this question, guys, I would have a T0, T1, T2, T3, T4. Are you guys comfortable with that? So it's a little bit difficult when I'm writing so small, but do you guys get the idea of what's happening here? You guys happy with that? So now I've set it out. And I'm going to put things into one of these 3 sections. Okay? And guys, it's much bigger than what you see up there on the screen, because in an exam, what happens is, you've got a whole page. You've got like 20 or 30 lines on that page. So look at the question, but in something like this, you're not going to have more than 15 lines each. And I like to actually do things on an open page, because then you can put all the information down as you go through and you read through something. And I'm going to do this in parts. So let's carry on. Sorry. Guys, it says separate calculations are needed for cash flows and tax. And I'm very interested in the way you approach this now. Is that okay? So I'm going to try to get your exam technique good today. It says tax is a cash flow and should be calculated separately. So what have I done by creating those three sections? I've created a space for myself to calculate tax separately. Often cash is paid out does not equal a tax deduction. An example of this would be a fixed asset purchase where wear and tear is calculated over the asset of the life of the asset for tax purposes. So we're going to see how that works inside this question. Is that all right? Guys, if tax is paid, place it into the cash flow calc in the year that it's paid. It says, if there's a loss, carry forward to next year. Guys, essentially, if you've got losses for tax purposes, it's got to stand on its own 2 feet. Is that all right? If I've got a loss, I'm not getting cash back. Not for this project. I'm only going to get it back next year when I make a profit. So if you see a loss, you don't work out a positive tax cash flow. Does everybody understand? You carry it forward to next year. Does that make sense, guys? It's got to stand on its own 2 feet. I'm not getting money back this year. I'll pay less tax next year because I've got a loss carried forward. Next. Assessed losses within the company should not be taken into account when calculating a cash flow, as the project should stand by itself. You can't sit there and say, well, shit, it's got a positive NPV because I've got a big assessed loss from last year. Whether you take a project or not, it should stand by itself. You shouldn't actually take extraneous things into it. Now, I'm not putting that into this example, but you'll see the example I do next week. I've got assessed losses and I've got tax losses in it as well. And you'll see how to deal with it. But baby steps for tonight. Next. It says initial investments into a project should be shown at T0 unless incremental investments are required. If there's a 1 million cost up front and a 300,000 rand at the end of year 3, place $1 million into T0 and 300,000 into year 3. It says if a tax allowance can be claimed in this amount, remember to include this in a tax calc. If T0 was a machine, calculate the depreciation allowances and put them into the tax calc. Knowledge of taxation rights for buildings and machinery is assumed. They're not going to tell you how a machine gets written off for tax. How is a machine written off for tax? 40, 20, 20, 20 if it's new, and second-hand is 20% straight line. Buildings, factory buildings at what percent? 5. This is postgrad. They don't need to tell you the shit. You're doing tax as part of your CTA. You need to know how this stuff works. If you get a patent, you'll do it at 5%. You get a design, you do it at 10%. You're required to know the stuff for CTA. Are you guys comfortable? So let's see how this is going to impact upon this question. So let's just see based on what we've just discussed. So inside the question, guys. Sorry, there. Guys, how much did it cost you to buy the machine? It says second-hand machinery costing 1610 including VAT would be purchased on the first day of the tax year. I was comfortable with that. So guys, it includes VAT. Can you get VAT back on a machine? Yes. Okay, so what am I going to do? Am I going to spend 1.61 million or am I going to spend 1.61 million times 100 over 115? The second one. So just do it. 1.61 million times 100 over 100 over 115. What do you end up with? 1.4 million. Guys, comfortable? Okay. So let's go back to what I've got here. Okay. So guys, which one of the 3 sections does it go into? Guys? Which one does it go into? Second section over here. Cash flows, not tax. Why is it cash flows, not tax? Guys? Because the cost of the machine doesn't go into my tax calc. So I'm going to sit there and say I bought a machine. And how much did I pay for the machine? 1.4 million. and it's a cash flow out. You guys comfortable with this? And what should you do automatically? Don't wait for the depreciation and all of that stuff. Rather, let's go and do it now. So in my tax calc, guys, I don't get a deduction in time period 0. I only get one in time period 1. I bought the machine second hand. Does everybody understand that? So what does it mean if you buy a machine second hand? How do you write it off? 20% straight line. Are you guys comfortable with that? So how much is your write-off? 1.4 million times 20%. How much is it? 280. So you're going to say depreciation of the machine, and we're going to write off minus 280, minus 280, minus 280, minus 280. We're going to put it all in. Are you guys comfortable with that? Cool. So I've put everything into my calc. I'm cool. Guys happy with that? Okay. Okay. Guys, I've got there the next dot. It says the way a project is financed is ignored when doing an MPV calc. If there's a machine costing 3 million, which is funded by a loan requiring 3 capital repayments of 1.2 million each, ignore the loan repayments and only put the investment amounts into the calculation, including finance charges, would be double counting. So guys, remember what I said with you. By putting in the minus 1.4 million, what has happened? I've taken into account everything. That's all the loan repayments, that's all the interest, that's all everything. I don't double count. I can't put in the 1.4 and put in the loan repayments. That would be double counting. Are you guys comfortable with that? And what happens? The investment decision is done before the financing. Because we don't know whether we're going to use a loan or whether we're going to issue shares because of that target capital structure that we've got, that target debt equity ratio. Are you guys comfortable? So if you see loans in a question and you see interest paid in a question, you just ignore it. It does not go into an NPV calc anywhere. You guys comfortable with that? Okay. Guys, it says the minus 3 million in time 0 hypothetically equals the 1.2 million paid in each of the 3 years. Does everybody understand that? You put the 3 million in, you don't put the 1.2 in. Financing is ignored for the investment decision. You guys comfortable with this? Next thing, financing of projects is calculated separately in the financing decision. This does not form part of the investment decision. I'm trying to give you absolutes here. Is that all right? Now, a lot of the stuff you may not have known in third year, but I'm trying to sit there in an exam and say, they will mix investment and financing, but what do you need to do? There's an order, WACC, then investment, then financing. They put financing into an investment decision, you just ignore it. You don't give a shit. And that's an absolute rule. You don't need to do anything. Next one. Guys? It says if research and development has been done prior to the investment project commencing, usually this is a sunk cost. What is a sunk cost? So I'm going back to MAC 3701. What's a sunk cost? Okay, I've spent it. No matter what I do, I'm not going to get it back. Think of it as taking that chick out on a date, and she ordered the lobster, and then you took her back home, and she said, thank you for the nice evening. I really don't want to see you again. It's a sunk cost. You're not going to get any return on your investment. It's finished. Okay, there's 0 you'll get back. Sunk cost. Guys comfortable with that? When is a sunk cost? When can something that you've paid for have a cash value? If you can resell it in some way. Does everybody? So maybe I can sell the research, okay? Or I know this oak that's going to take her out on a date next week. I'm going to tell him not to take her out, but I want him to pay me half of the value for that date because he's just going to waste his time. Are you guys comfortable with that? Okay, so it says there the sunk cost usually cannot be recovered and so should be placed into cash flow at a 0 value. Now guys, here's an important thing. It's in the question. Unless you write it in a solution, you do not get a mark. Does everybody understand that? So if you see a sunk cost, what should you do? Write it down, say sunk cost, and put a 0 in the solution. Don't sit there and say it's not a cash flow, I'm leaving it out. You will lose a mark because there's a mark for saying we don't put it in. And unless you write something down, you do not get a mark for it. Does everybody understand that? Next one. It says if the research can be sold, the relevant cost is the net amount the research can be sold for, taking tax effects into account. Is that all right? So let's have a look at this question. Okay, so this question, guys. So it says, Betty inverter was set up 2 years ago to exploit Eskom's load shedding problem, selling inverters into households. 1.2 million was spent developing inverter technology that could be used within households. So the amount that you spent on the inverter, is that a relevant cost? I've spent it. No matter what happens, I'm not getting that 1.2 million back. So what should I do in the solution? I should go here. It's not a tax cash flow because it happened 2 years ago. Okay. And I'll go development cost. And then I'll put probably something in saying it's not, it's sunk or whatever, something like that. And I'll put a 0 into a solution. Are you guys comfortable with that? Now they can give me a mark because I told them the 1.2 million doesn't go into my solution. You guys comfortable with that? Next. Let's carry on. It says the company undertook a research project and believed that there will be markets in Durban, Cape Town, and Joburg. It decided to open up one shop in each of these 3 locations. Okay. Market research cost 70,000 to perform. Believed that there was a viable investment opportunity. So guys, the market research I need to put in my solution. Is that a sunk cost? Sure. So marketing cost, sunk, with a 0. You guys comfortable with that? Again, you'll get a mark because you're telling them, I've spent it. I'm not getting it back. Okay, carrying on. It says, Arrival also believed that the product was viable and made an offer to buy the technology. The company would receive 1.3 million after tax on the sale had been paid. Now that's relevant. I have a choice. I can either sell it for 1.3 million rand today, okay, or not. So what is actually the cost of me holding on to this research? 1.3 mil. Are you guys comfortable with that? So what am I going to do with the 1.3? I'm going to say it's like a cost to me. Cost of the project of holding on is another minus 1.3 million at time period 0. But this one's not tax deductible because I deducted it 2 years ago. Are you guys comfortable with that? Are you happy? So costs are normally sunk unless you can sell it for something. If you can sell it for something, then it becomes a relevant cost and you put it into your cash flow. Are you guys comfortable with sunk costs? Now, just about every single exam question I've ever seen has always got sunk costs in it. And normally there are 2 of them, one which you cannot get back and the other one which you can sell. So the one you put a 0 in for and the other one you put how much you can sell it for. Now, guys, it's normally the after-tax cost. So with this one, I like to keep this example nice and simple. So I said this is how much you would get after tax. You understand that in a question next week, you're going to have to work out how much the tax is that you'd have to pay on the sale, and you'll put that into the cash flow as well. You guys comfortable with that? But I just made it simpler for today. Guys comfortable with this? Okay, so with costs incurred before the project starts, are you guys comfortable with how to deal with those in a cash flow calc? Is that all right? Okay. So let's go back. Okay. Next one. Okay. I've got there only use relevant costs. It says if you have a raw material that cost 100 but would cost 150 to replace, use the 150 in your cash flow calculation. Do you understand? It's not what you paid for it. It's how much it would cost you to replace it. That's relevant. Does everybody understand? Okay. That's why Dion got into so much shit in the late 1990s. The exchange rate went out for a ball of shit. It was like a little bit like what happened when Des Van Rooyen kind of like came in, and the exchange rate went from like 10 to 20 in like before you could blink. You guys understand? They sold their stock, and then they went, oh shit, I only got 10,000 Rand for selling the TV, but to buy that same TV cost me 15,000 Rand now. Oops. Do you understand? How should you actually work out your pricing? Based on what it is now, not what it costs you. Accounting profit means nothing. Are you guys comfortable? And there's lots of retailers that have got into trouble with that concept. So when they downgrade us, if you're in retail, wait to see where the currency goes, and then even if you have to sit there and say, I bought it for 5,000, if it's going to cost you 10,000 to replace it, you mark it up to 15. Because you will still be there. Everybody else will sell their stock and realize that they can't replace it because they don't have money in the bank. Are you guys comfortable with that? Okay. Guys, so let's look at the question. Let's see what happens. So guys, it says a factory would be set up in Joburg, blah, 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 blah. I've got their working capitals required for the factory. This is to be financed by spending 200,000 in new purchases and taking existing costs that cost 30 that has a resale value of 50. So guys, what am I going to put into working capital? How much? Is it the 200 is 200? There's no doubt about that. But for the stock, do I put in 30 that it cost me, or do I put in 50, which is its current resale value? I've got to put in 50. Does everybody understand that? So working capital management, going back. Which section? Cash flow, not tax, or cash flow tax? Do you put working capital into your tax calc? No. So working capital minus 250K here. 250. Everything goes in at relevant cost, not at what it cost you. Guys comfortable with it? Okay. Carry on. Yeah. Yes, it is. That's why it goes in. It's relevant. If I sell it, I'll get 1.3. That's why it must go into cash flow. Okay. Let's carry on. Guys, it says there are many considerations for working capital required. Let's go through this. It says working capital investment is not tax deductible. So that's first and foremost. That's why it's in the non-tax deductible section. It says if it is shown as an outflow in the year it is expended. So in this question, 250 out, time period 0. Guys comfortable with that? Okay. It says working capital should flow back to the enterprise at the end of the life of a project. And I've got to consider Chicken Licken. So rather just listen to me. I run a Chicken Licken shop. Okay. So when I start the Chicken Licken franchise, what do I need to do? I buy chickens. When I'm closing it down, what's going to happen? I'm going to keep on buying chickens, or am I basically going to say at the end of it, I'm going to run my stock down to 0? You're going to run your stock down to 0. Does everybody understand that? Is that cool? Okay. So what happens? Cash flow out, time period 0. And when you close down, you run your stock down to 0. So it comes back to you at the end of the life of the project itself. Does everybody understand that? Now, there's no inflation inside this question. Okay. So what are we going to do? 250 out, and then the 250 comes back in time period 4. Are you guys comfortable with that? Does that make sense? I get my chicken back. Just remember it from that perspective. Okay. Okay. This thing, guys, I'm not doing it now. I'm doing it next week in detail. But can I just explain something to you? I just want you to just think about this concept. Guys, do we ever inflation adjust tax flow amount, tax amount? Do we adjust tax for inflation? Never. Okay. So basically, guys, if they want to give you real numbers without inflation added onto them, can you use them in a question? No. Because you've got to do tax in in nominal numbers. Because you've got to do tax in nominal numbers, you have to do your cash flows in nominal numbers as well. Otherwise, you're not going to get the right answer. So if they ever give you real numbers in a cash flow, and you may not understand what that term means now, I'm going to do it in detail next week. You always convert real numbers to nominal numbers, because tax is always in nominal numbers. So if you're going to put your tax in nominal numbers, you have to put your cash flows in nominal numbers as well. So you can read that, but I will do it in detail with you next week. Is that all right? There's also differing inflation rates for different items. In South Africa, salaries is outstripping inflation. The guys sit there and say, I know inflation's 4%, but we want 14% increase on the amount. You've got to use nominal numbers, because salaries need to go up by 14%, whereas sales will go up by 4%. Are you guys comfortable with that? You have to use not real numbers, the actual numbers, the actual cash flows. But I'll get onto that next week. Okay, next one. It says, know the difference between markups on cost and on sales. Okay, so what I'd like you to do is, will you please just do sales in the question? And I'll ask you to try to do sales now. Guys, so here we go. It's got sales will be 2.2 million per store in year one. And we'll have a GP of 60% on cost. Gross profit will go by 8% for 2 years, reducing by 15% per annum thereafter. Can I ask you to just try to do this? If you get it right, nice pats on the back. If you get it wrong, you'll learn something. But this is the way it's normally worded in a question, and I would imagine that most of you will get it wrong. Guys, so this is kind of like what you should have done. And if you make a mistake, please learn from this, because it gets asked in exams often. Guys, it's 2.2 million per store. Did you all remember to times it by 3? Yes? Now, guys, I just want to put my profit into my cash flow. Are you guys comfortable with that? So what's the next thing that I do with what do I do? Times by what? Someone? Okay. Very good. Guys, why am I saying times 60 over 160? Because the GP is on cost. So what I'm going to do is I'm going to say, listen, my cost is 100. My GP is 60. So it's 60 over 160. Did you all do that or not? Most of you wouldn't have done that. So please, whenever they're doing GP percentages, just see whether the GP percentage is on cost or on sales. So most of you would have said times 60%. That's wrong, because that's a GP on sales. Does everybody understand that? So see whether, when they mention gross profit percentages, see whether it's a GP on sales or whether it's a GP on cost, and make sure you read it properly. If you made that mistake, you should actually keep a fuck-up sheet and actually remind yourself to do that. In exams, they don't do GP percentages on sales because they know that you'll get it right. What do they try to do? Normally on cost, because they're going to see whether you read properly or not. Okay? So it's more likely to see it this way in an exam. Are you guys comfortable with that? And then you'll plug it in. Do I need to do the numbers across in the table itself, or are you comfortable with this? So you'll do that for year 1, and then times by 1.08 for year 2, times 1.08 for year 3, and then times by 85% for year 4, because it's going down by 15%. You guys comfortable with that? Is that cool? Okay. Let's go back to what else they can do inside questions. Guys, it says different cash flows may have different inflation rates as time progresses. Okay, sales may have an inflation rate of 7 and salaries an inflation rate of 10. This is relevant in SA where salary inflation has outstripped inflation. So guys, just read, and you'll use this percent for this number and this percent for that number, and it's absolutely fine. Are you guys comfortable with that? Guys, It says if probabilities are given, calculate the amount of the cash flow using probabilities. So inside this question, there is something with probabilities. Oh, by the way, sorry, just where do the sales go? Where are you going to put the sales? You're going to do it up here. Are you guys comfortable with that? Okay, I'm going to hand out the solution to you. I'm interested that you understand the process. Guys? So, guys, there it is. So inside this question, guys, it says there's a 40% chance that operating costs for the whole company, including depreciation, will be 1.85 per annum, and 60% chance it will be 2.1. So how am I going to do this? So first things first, guys, whenever you're dealing with costs, you need to take out non-cash items. Is that all right? Okay. So, guys, from a depreciation perspective, guys, you're buying it for 1.4 million and you're writing it off over 4 years. You guys comfortable with that? So 1.4 divided by that amount. What's going to happen? I've got to take my depreciation out. Are you guys comfortable with that? So I'm just going to bring up the solution now. Sorry, just let me just open it up. Sorry, that one. Okay, make it a bit bigger. Let me take it out. And then just, where's it view? So just, let me just increase the view zoom. There we go. So guys, what are you going to do with this? What you're going to do is, with the operating cash flows, you're going to say it's 40% times 1.85 million plus 60% times 2.1 million gives me 2 million. Guys comfortable with that? And that's including depreciation. What am I then going to do? I've got to take out the non-cash flow item. So minus 1.4 million times 25%, because for accounts purposes, I'm writing it off over 4 years. Are you guys comfortable with that? And there's my cash flow. And depreciation's not a cash flow. And there it's 1.6, 1.65, 1.65. Are you guys comfortable with this? You guys happy with that? So if you've got probabilities, 40% times this plus 60% times this, and then just always with costs, please, they always will put in a non-cash flow item with it. And you need to remember to take the non-cash flow item out. Is that all right? There's always depreciation. You've always got to look to see where you're going to take out the depreciation. How many of you would have forgotten to take out the depreciation? Do you understand? Just use this example just to point out all of the bad points that you have. Are you guys comfortable with that? Okay. Let's go back to the question. Okay. Guys, marketing costs will be 200,000, reduced by 20% per annum based on the initial marketing cost. So tell me what you're going to do, guys. Just work it out. Just work out the first 3 periods quickly. What you would do. So period 1, how much is your marketing? 200. How much is marketing for second period? 160. Correct? How much is marketing for your third period? I've got 130s and I've got 120s. What does it say? It's based on initial costs. So don't sit there and go times 80% times 80%. That's wrong. Okay, it's RTFQ. Read the effing question. Then you'll have happiness. But you guys understand, I've just drafted it in such a way that I've seen them do stuff often in exams, and I'm just trying to teach you how to read properly as well here. See whether the 20% is on initial or whether the 20% is reducing balance. Okay, inflation, it's incremental, so you do it that way. Whereas with this one, it's on initial cost, so you've got a fixed base that you've got to use. Just read the question carefully. Are you guys comfortable with that? I've got the one thing I didn't do, guys, a little bit earlier. It says it was going to get sold. Oh, no, it's maybe still down. It says all amounts exclude VAT. Second-hand machinery written off 20%, straight line. The machinery will be sold for 400 x VAT at the end of year 4. So what have I got to do with the 400,000? I've got to put 400,000 as a cash flow in. Where? In my operating, in my tax section or in my not tax section? Your not tax section. But what do I put in my tax section? I say selling price is 400. What is my tax value, guys? 1.4 million minus 1.4 million times. I've got 80% there in the solution. Do you guys see this over here? Because I've written it all 4 years at 20%. Guys, comfortable. And then, guys, what happens is I then add up this. Does everybody see that? I then take it and I put it down into my tax calc, so that I don't need to actually write all of the lines out twice. Does everybody understand where I'm coming from? Okay. I've got my depreciation, I've got my recoupment. I then work out my taxable income. Everybody happy with that? Times 28%. And guys, they actually give you a mark for that. So there's no way that you're going to get this right in an exam. Does everybody understand? So if you do get it right, that's fantastic. So what we do when we mark, guys, is if you write down tax at 28%, traditionally we go and we give you a mark over there because you're showing us that you know what the right tax rate is. And then what we do is we see whether you take the 96.6 and then we transfer it properly and we give you a mark up there. So we're going to carry the error through. Does everybody understand where I'm coming from? Is that cool? So that's normally the way that we instruct it to mark, because the chances are you're not going to get your tax calc, the number right. But we need to be able to mark it properly. So you must put in the 28 and you must transfer it up properly. And guys, if it's a loss for the year, you don't transfer it up. Does everybody understand? Because the investment project has got to stand on its own 2 feet. You don't get, SARS doesn't say, oh, look, you made a loss, let me give you money. SARS says you made a loss. Next year you can claim your assessed loss. So guys, losses are not positive cash flows. Are you guys comfortable with that? I get upset in undergrad because often they actually put them in as positive cash flows in undergrad and they're not supposed to be positive cash flows. Are you guys comfortable with that? Is that cool? So do you see the process that I've got over here, guys? And then, guys, what do? You write CFO, CF1, CF2, CF3, CF4, because in your solution, what are you required to do? Show them how you're doing your calculator. You must write down I equals 12%. And normally we'll sit there and we'll go 1 mark. And we'll give you 1 mark because you've got the cash flows in the right period, because we've got to carry your error forward. Does everybody understand? Then there'll be an NPV calc. Okay, but what we're interested is, if it's a negative, you need to say, should not be undertaken. If it's a positive, should be undertaken. Does everybody understand? So depending on what you get, we'll modify our marking to show what you get. Now guys, you'll notice in the solution, I did IRR as well as NPV when I did the solution, because it just said, should we accept it or not? Okay. You can use IRR or you could have used NPV, either one of the two. Do you guys understand? So both would be marked correctly here because they just asked, should you undertake it or not? So no, we shouldn't undertake it. But what's the second option, guys? What should we be doing? Sell it for 1.3 million and take your cash now. Does that make sense? So if you're not going to do it, I'll take the 1.3 million cash now and give it to me. Are you guys comfortable with that? So you need to write that down as part of the solution. So I just want you to just have a look at this as a way of actually just setting out stuff, how to read questions and to do stuff like that. Is that all right? Does that make sense, guys? So this is always a good way to actually just see whether you actually set out properly. Just from a reading perspective, your major problem is reading. It's not that you don't understand how to do NPVs. You just don't read properly. Are you guys comfortable with this? Is that all right? So if you guys, the solutions here, if you guys can actually work through all of this stuff, guys. So you guys can come and collect it over here. And I'm going to carry on with stuff for next week. So inside the class, would you please just log on, and then I'm going to post some homework for you to do. Is that all right? So there'll be 2 homework questions for you to do for NPV, just simple things. Just make sure you know how to do the calculations properly. And then 1 or 2, just like, I'm not going to give you separate things for WAC. I'm actually going to give you like an integrated question where you're going to have to work out the stuff. And I'm going to start next week's lecture by just going through the tutorial work that I asked you to do. Is that all right? You'll see the 2 questions look very similar for WAC, but they've actually got totally different solutions. You've got to read the required properly. Okay? They look like they're almost identical, but they're not. They're very, very different. Are you guys comfortable? So will you start working with it? Guys, just another thing with Mac. I just need you to say something. Please, if you try do some Mac homework at some stage over the weekend. Actually, no, you've got a double lecture, so it's a bit difficult. But just have a look at the stuff. Just with Mac, you'll find that you don't need to learn for exams if you do the work and you understand the concepts. Does everybody understand that? So it's one of the things that you should try to do your homework for and actually just get everything right for. Is that okay? But I'm just doing the basics now. I'll probably spend more time in class just going through the stuff with you next week, because you've got Saturday and Sunday. You've got Saturday, I think, is FINAC, and then Sunday is audit. Okay. Sorry. What they try to do just is to actually just do a little bit of a block release so you can start working on everything. And then we'll work through the stuff. Is this okay, guys? Okay. No, that's cool. What I might do is I might have some Mac notes for you to collect on Saturday or Sunday. Is that all right? But they'll be put up into the classroom if you want to have a look at them before your lecture. Yeah. Huh? Yeah. No, it doesn't. You sold it in year 4. Okay. Thanks, guys.